All right, today we've got a really fascinating story. It's about a company called Bellring Brands, where the market is basically hitting the panic button, but the people inside the company, well, they're betting big with their own money. So what is going on here? Let's dive in and find out.
So let's just get right to the heart of the puzzle. Why are the people who know the company best, the actual insiders, so aggressively buying up stock at the exact same time the wider market is just punishing it? It doesn't quite add up, does it?
And this right here lays out the whole conflict perfectly. On one side, you have the market signal, and it is screaming danger. The stock price is cratered by a third, and there's a lawsuit hanging over their heads. Yikes. But then you look at the other side, the insider signal. These guys are net buyers of over 500,000 shares, and the company itself just approved a massive $400 million share buyback. It's a total showdown between fear and conviction.
Okay, so to get to the bottom of this, we've got to do what you always do in these situations. You follow the money. And that means asking a really fundamental question. Who actually owns this company? Because the answer, as you're about to see, is pretty unusual. And it's our first major clue.
Yeah, just look at that number, 98.7%. That's basically the entire company. It is almost entirely owned by institutional investors. We're talking professional investment firms, hedge funds, the works. So its fate really lies in the hands of what people call the smart money.
And when we dig into who these institutions are, it gets even more interesting. You've kind of got two different flavors of smart money here. First, you have the giants, right? BlackRock and Vanguard. They're mostly just holding steady, since a lot of their money is tied up in passive index funds. But then you have the active players, the hedge funds. Take a look at D.E. Shaw and Citadel. They are not just sitting on their hands. They are making huge, aggressive moves, cranking up their stakes by 41% and a whopping 114%. That is not passive investing. That is a high-conviction bet.
So the big takeaway here is that this isn't just random market noise. What we're actually seeing is a really powerful vote of confidence, and it's coming from some of the most sophisticated, data-obsessed investors on the planet. They are actively choosing to double down.
Okay, so that naturally leads to the next question, right? How in the world did Bellring end up with this kind of bizarre institution-heavy ownership structure in the first place? Well, to figure that out, we have to rewind the clock a bit to a really pivotal moment in their history, the Great Separation.
It all goes back to this classic business problem called the conglomerate discount. So here's the idea. Imagine you've got this incredible high-performance racing engine, but it's stuck inside a totally boring, everyday family sedan. When people look at the car, they just value the whole sedan. They completely miss the amazing engine inside. Well, that was Bellring. It was this fast-growing, exciting nutrition business, but its real value was kind of hidden, lost inside its huge parent company, Post Holdings.
So to unleash that hidden value, Post played the long game. They had this really smart multi-year plan. It kicked off with an IPO back in 2019, but the big finale came in March of 2022. That's when they did the full spin-off. Post basically just handed over its huge chunk of Bellring stock to its own shareholders, essentially setting Bellring free to be its own independent company.
And wow, this move just completely changed the game overnight. One day, a single parent company holds a commanding 71% stake. The next day, boom, it's gone. Bellring becomes what's called a pure play investment. And what that means is, if you buy their stock now, you're making a direct, focused bet on just the high-growth nutrition market. And for those specialized institutional funds, that was like ringing a dinner bell. They came rushing in.
Okay, so we've got the big institutions making their move. That's a huge signal. But now we get to what is, for my money, the most compelling piece of evidence in this whole puzzle. What are the company's own executives doing with their own money? It's time to see how they're betting on themselves.
And if you look at the insider trading data over the last year, it's pretty revealing. Sure, some executives have sold shares. That's totally normal. They have to cash out options, pay taxes, whatever. But look at the buying. It has been way more aggressive. When you net it all out, they have bought over 500,000 more shares than they've sold. They are, quite literally, putting their money where their mouths are.
And this wasn't just some casual, everyday buying. Get this. Back in August of 2025, the company released some news that sent the stock into a nosedive. It plunged 33% in a single day. So what did the insiders do? Did they panic and sell with everyone else? No way. Multiple executives, including the chief legal officer, stepped right to that chaos and started buying up shares at a huge discount.
That kind of action speaks so much louder than words. It's one thing to put out a press release saying, we're confident in our future. It's another thing entirely to take out your own checkbook and start buying when everyone else is running for the exits. That is the strongest possible signal that management believes the market's freakout is just a temporary overreaction.
But it's not just their personal money. Their personal bets are being backed up by an even bigger corporate bet. The board of directors has given the green light for a massive $400 million share buyback program. So how does a buyback work? It's actually a pretty simple but powerful idea. The company uses its own cash to buy its own stock right off the market. This reduces the total number of shares out there. So if you're a shareholder, your slice of the company pie just got a little bit bigger without you having to do a thing. The goal is to make every remaining share that much more valuable.
Think about what that means. The board is basically shouting to the world, hey, we looked around for the best place to invest our money, and the most profitable thing we can find is our own stock. So when you put that together with the executives buying with their own paychecks, what you get is this unified, incredibly loud signal of confidence coming from the people who know the business best.
All right, so let's put all the pieces on the table. We have the smart money, the big institutions, making huge, aggressive buys. We've got the insiders, the people running the show, buying with their own cash. And we have the company itself saying its own stock is the best deal in town. So, after all that, what's the verdict here?
Well, it really sets up this classic dilemma, doesn't it? The bull case is incredibly compelling. You have the people who know the company best both inside and out, betting heavily that the stock is cheap. But the bear case is real too. The market hates uncertainty, and that lawsuit, combined with worries about short-term performance, well, that's a major source of fear.
And that brings us to the final, critical question. It all comes down to this. Who do you trust more? Do you trust the fearful market, reacting to headlines and short-term noise? Or do you trust the confident insiders who are backing up their deep knowledge of the business with their own cold, hard cash? Deciding which of those signals you believe, well, that's the billion-dollar bet at the heart of the Bellring Brands story.